Welcome back to Ask Me Anything Housing. We're here with our panel of experts, Ron Butler of Butler Mortgage, Lauren Hall of Zoocasa, and Bob Dugan of Canada Mortgage and Housing Corporation. Those phone lines are open. We'll put the number up in just a second, 1855. We'll put the number up and you can see it. Be easier that way. We have an email here from Doug in Calgary. In the recent inflationary and rising rate environment, I've often wondered just how much the cure has aggravated the disease. In other words, how much of our current inflation is related to larger mortgage payments due to those higher rates? So kind of a chicken and an egg question. Bob Dugan, could you take that on?
Yeah, sure. It's a very good question. And it's a question that becomes more relevant as we have or as the bank, I should say, has more and more success with combating inflation. When you think back a couple years to June 2021, the inflation rate was 8.1% year over year. Sorry, I said June 21. I meant June 2022. Inflation rate was 8.1% year over year. And it was fairly broad-based inflation that is, with increased interest rates, more and more of the different components of inflation have been settling down. And one of the strongest components right now is shelter costs, which is accounts for about 25% of the CPI. And a big part of that shelter cost has to do with mortgage interest costs. And so that's certainly one of the fastest growing parts of the CPI right now. And so certainly, and this speaks a lot to the difficulty with running monetary policy. It's tricky because, there's always this question of when do you start cutting? The Bank of Canada, on the one hand, has to make sure that inflation is defeated before they start to cut too far, because if inflation starts to rear its ugly head again and they have to reverse course, they have to worry about that and their ability or the credibility they have in fighting inflation. So they don't want that to happen. So that's the one side of the double-edged sword. On the other hand, if you keep rates too high for too long, you can exacerbate inflation through mortgage interest costs and maybe create too much of a slowdown in the economy. So it's really a balancing act that's very, very difficult to achieve. And the bank's doing a pretty good job so far, and we're seeing inflation come down fairly gradually. The latest numbers, 2.7% for June for year-over-year CPI, is in the target range. It's not quite at that 2% level they'd like to have, but it's in that 1% to 3% target range. So, and core measures of inflation have come down, but there's still that outstanding issue of shelter costs that are high. And I think we'll see that start to come down now as interest rate decreases continue over the coming years as the Bank of Canada gets back to a more neutral policy.
We have an email from Mark asking an intriguing rhetorical question. Why does the seller have to pay the buyer's real estate agent? The seller doesn't pay the lawyer, accountants, etc. And the agent is working against me, a seller, to get the lowest price. Yet I'm paying him or her. Please explain. Mark, Lauren, could you take that one on?
Definitely. This is a spicy one these days with all the commission suits going on in the States.
Yes.
And so the quick answer is you actually don't. And so you decide. So if you decide to hire a real estate agent to sell your house, you can decide at that time if you want to offer a commission to a buying agent or not. So it's a lot of people don't understand this, but you can sell your house however you'd like to. So a lot of people choose to sell their house using a real estate agent because if you're going to do this transaction 1, 2, maybe 3 times in your life, and it's a big meaty transaction, you want to make sure that you're putting it in the hands of a professional who it's not their first time. And so people choose to incentivize buyers agents to come and bring their buyers to homes. The nuts and the bolts of why it makes sense for the seller to often pay the buyer's agent is that they can then put it on the mortgage. So imagine a first-time home buyer buying a house for $500,000, I don't know where, but buying a house for $500,000. And now that buyer can put down 5% towards purchasing that house in cash and put the rest as a mortgage. If they have to pay their buyer's representative for the commission as well in cash at closing, that makes it a much tougher proposition at the time. So in order to get the highest price for your home, sellers often opt to pay the buyer's agent for them.
But I could hire an agent to handle the sale of my home.
Correct.
And I could say, sorry, buyer's representatives get nothing.
You can do anything you would like to in a negotiation. And so It is up to the seller to decide what is most likely to get me the highest net dollar in my pocket at the end. And in the last 30 years, at least, most sellers have decided that the best way to net the most on this sale is to hire a professional real estate agent and also pay a buyer's representative.
It's a great topic. We could probably
do an entire hour.
Yeah.
Yes.
Let's head to Port Elgin, Ontario. Scott, go ahead, please.
Yeah, thanks, guys. I'm not sure. This is not a direct real estate question. It's more about investing in Canadian banks. I don't understand why Canadian banks take these massive loan loss provisions, mostly related to Canadian real estate, and then how do I make decisions around this when they're making so many bad decisions about who's making or giving loans to? So can you help me understand how these provisions work in the Canadian banking system? Thank you.
Ron, could you take a swing at that?
Sure, I know a lot about that. So the reality of life is we have a very low default mortgage rate in Canada. It's one of the lowest in the entire world. Well, it's still about 18 basis points, which is far below the United States. The loan loss provisions are rational because they're not just for mortgages, they're also for credit cards, auto loans, a whole bunch of other things. And they will prove to be correct. I mean, there will be substantial credit losses at the banks. So they're provisioning properly. As far as the mortgages are concerned, we will see increased defaults in the mortgages. And the idea that they're just giving out mortgages to anybody who wants them, as somebody who's involved in convincing banks to get mortgages, I will absolutely assure you it is not easy in any way, shape, or form. So the real answer is the banks are provisioning correctly, but there will be continued credit losses.